Hello, everyone. It's always so awesome to see new names, new faces, and great turnouts when we run these workshops. A lot of you all are running exciting companies, and it's just an awesome opportunity for me to meet so many people around the world. Would love for you guys to, if you can, come off and turn on your videos. Love seeing faces. We're going to start this just by saying hi to everyone. I know you guys have been throwing your name into the chat, which is amazing. You should know that a lot of you are coming from around the world. We started this obviously as an American-focused project and company, but we've been super fortunate to be able to connect with founders around the world. So I think the first thing we're going to do is try to get a better sense for where everyone's coming from, not just through the chat, but through a quick poll. So if you don't mind, Jonathan, do you mind showing the poll so that we can get a better sense of where people are coming from? We're going to take 2 seconds and figure out where everyone's coming from. Let's see.
Waiting for the participants. And end it in 5, 4, 3, 2, 1.
Can you tell us what we're seeing in terms of where people are coming from?
Yep, definitely looks like 63% from the US. We also have good representation from Latin America, Europe, 14%, 13%. Asia Pacific coming in right after it, 5%.
Asia Pacific. What time is it in Asia APAC right now? It's like close to midnight, if not later. So for all of you that stayed up late, woke up early to join us, we're super excited. I don't know if you saw this, but we tried to extend the session by another 15 minutes. We always tried to do it for 60 minutes, but those sessions always end in a rushed manner, and we wanted to add a little bit of padding. So hopefully you guys will be able to stay with us for another 15 minutes. Okay, lots to cover. So I'm going to jump right in and share a little bit more about the workshop. So this is how to raise from VCs in 2023. It's important to note the 2023 part of that because, wow, things have changed. The market is shifting. It's a crazy time to be out here, but we're going to make things better for everyone. In terms of housekeeping, I already asked you guys, cameras on, that'd be awesome. Whenever I'm lecturing or going through exercises, I try to look at the camera and see if Nathan is furrowing his brow or Larissa is just not having anything that I'm saying. And I can only tell that if your cameras are on. The Zoom chat is open, like I said in the chat. We've seen some amazing connections happen through the Zoom chat. So please interact, throw your questions in there as they're going through. Jonathan's going to be monitoring things so we know if we need to pause and answer questions there. And then share your favorite insights on social. There's going to be a lot that we cover. If anything's cool to you, feel free to screenshot it, send it out. We're not necessarily trying to keep this to ourselves. We want to help as many people as possible. And the last thing, the housekeeping item, and this is the most important one. If you've been to any of my workshops before, either in person or on Zoom, you know that I try to make them as interactive as possible. I do that by asking for volunteers. And I always tell people, if you are someone that volunteers and you will be, and if you can mute, that would be great. If you interact with me, you will get the most out of this workshop. And when I ask for volunteer, if people don't volunteer, I am not shy about cold calling. And then last but not least, I've started to do, it's really important that even if you don't get called on, that you think to yourself, if I did get called on, what would I have said? How would I have answered that question? How would I have interacted? It's all about the value of simulation. Simulation in your head, even if you're not doing it yourself, can be a great way to internalize teaching and workshop information. So, okay, great. So this is a 3-part workshop. I'm not sure if you realize that you signed up for that. We have one today, we have part 2 on Wednesday, and we have part 3 on Friday. I do want you to know a little bit more about the work that I do. 95% of my time is all about creating free content from my weekly newsletter, my podcast, investor list, tools, workshops like this to help founders fundraise more successfully, make it easier on you all. And really my goal is to, with as light of a touch as possible, get you all to start companies, capitalize them, put innovations out in the world, help with transfers of wealth, all those things like really, really light up my life. And it's the reason we do things. And I want to do that with as light of a touch as possible, but I want you to know also that 5% of founders that follow my content started following me with my newsletter and really asked for deeper levels of support and coaching and interactivity. So we did create a separate program that is designed to help founders that are trying to raise in the next 6 months that want a deeper level of connection and more accountability, more community. So there is a program that we will be talking about at the very end of all of this. So on Friday. So we'll get to that later, but I did want you to know that that is part of this program. But you should know that we are trying to lean into this workshop as heavily as possible. You're going to love what we cover in the next 3 days. All right. So in any workshop that I give, I do always start off with a little bit of background on myself. If you've been to my workshops, you can tune out for now because next minute will be something you've heard every single time. But my background is I ran the new media product group at MLB.com before becoming a venture capitalist at Greycroft for a number of years. After that, I did my own tours of duty as a venture-backed startup founder, the last of which I was co-founder and CEO of a company called Tape. I raised a couple $1 million from a firm called Greylock up north, ran that for a few years, had a small exit in 2020, and then shifted over to becoming SVB's internal fundraising coach. And then in the middle of the pandemic, really decided to do this full time as my company, Adamant. So Adamant is dedicated to making fundraising easier and more accessible for as many founders as possible. We do that through all the content that I talk about, this workshop, podcast, etc. Now, why did I rush through that introduction about myself? It's not to necessarily puff myself up or credential myself, but it's really about giving you all context for the advice that I'm about to give. And I always start with this preamble because I think context is incredibly important for any piece of advice that you get in life. But in particular, in startups and fundraising, context really matters. That's because I feel like any topic that's worth giving advice around on the internet with pundits and experts all around, blogs, Twitter, any topic worth giving advice around, you're liable to find 2 equally credible people that will give you 180-degree exact opposite pieces of advice. And that can be frustrating unless you understand why that happens. So this is the example that I always give. It has to do with the advice around when founders should be sharing their data rooms with venture capitalists. And take a second to kind of read these blurbs. But in general, what you should know is that on the left, Andrea Funston from Basecamp essentially says that the moment she meets a founder, if they share a data room, even before they've even really engaged, that's one of the highest signals that she looks for. It's an amazing thing. All founders should do that. Whereas on the right, Mark Suster from Upfront Ventures in a blog post essentially says founders should never share data rooms with VCs. And so how could 2 VCs have the exact opposite piece of advice? Yes, those pieces of advice can make your head spin if you're like, well, what the hell am I supposed to do? The reality is if Andrea and Mark sat down for a drink and wanted to chat about what they thought about data rooms, I think they would actually kind of agree on a lot of the same things. It's just the way that it's delivered in social media makes it sound like they have 2 opposite viewpoints, completely opposite ones. And so I think whether it's me or anyone else, you really have to think about where that person comes from, what their experience has been in the past that has brought them to this point of giving this type of advice. And I also encourage you, whether it's me or anyone else, when you do get advice, and especially if it's soundbitey, really dig into it, ask questions, ask for more details so that you can apply it yourself. None of this advice should be thought of as stuff that you blindly follow. You don't understand the first principles behind, you just execute on. It's meant to be the first step of better understanding what it means to be a great fundraiser. Okay, so that's my disclaimer. That's the thing that I lead every Fundraise workshop with. Next. So what are my workshop goals? Part of this is going to be sharing a little bit more about my deeper program, but I want you to know that, again, I'm truly, truly committed to trying to help people with as light of a touch as possible. I want you guys to be able to run through this workshop, capture a ton of value, and go on and raise millions of dollars and never talk to me again. That would be a delight. And so all my workshops are really focused on delivering value and solutions. You'll see that throughout today, Wednesday, and Friday. To lead with that, though, to make sure that you do get at least something tangible that you walk away from, something that you can execute against. That was some of the feedback from my last workshop. It's like, God, that was nice information, but not all of it was actionable. And I read every comment, I read all the feedback, and we try to become better. So I did want to lead with this. We're going to make sure that you guys walk away with a little bit of a jackpot. So we're constantly doing research around investor lists in my company. There's research that we do on a primary basis. So there's a list that we sent out about all the VCs that had done deals in November so that we're actually active. We do other research lists, and then we also curate lists from the internet, and we've recently updated that curated list of databases. We're going to send that to you as a thank you for attending this workshop today. And we're combining that with a few important email templates that together should relieve a lot of the pressure, or at least some of the pressure associated with executing a fundraise. So that's my gift to you all, to make sure that you walk away from this with a little bit of value. All right, let's get into the workshop and exactly what we're going to be training today and going through. It's our today's focus for me is solving the biggest problem in fundraising. So what do I think? And I've had a lot of time to think about this because I iterate on these workshops. They're never exactly the same. Today, what I feel like is the biggest problem in fundraising is that founders don't deeply understand what fundraising is. And they have misconceptions about fundraising that actually handicap their ability to execute well. Now, this might feel like a very amorphous topic, but it's incredibly important. And it's going to lead to some very specific exercises that we'll go through in a little bit. But that's what we're going to be focused on today. Can we solve this problem first so that you guys can actually go out into the marketplace, into the sea of investors and VCs, and have a better handle on what you're actually doing? Okay, so this is going to be our first opportunity to engage. I want to ask you all to be brave and talk to me about what you think fundraising is. So you guys know how to digitally raise your hand. I'd love someone to volunteer. And if there aren't volunteers, like I said, I would happily cold call. Okay. We've got 4 volunteers. The first one, Daniel. Daniel, is that how you pronounce it? Daniel?
Yeah, Jason.
Awesome. Where in the world are you calling in from, Daniel?
Austin, Texas.
Daniel, what type of name is Daniel?
Parents made it up.
Dutch or something?
So one parent wanted Nathaniel, the other wanted Daniel, and they made it up.
I love it. Okay. Tell me what you think fundraising is. And there's no real like direction we're going in here. I just want people to articulate what they believe fundraising is.
Yeah, I'll just add one, and then I know others can add to it, but relationship building.
Love it. Okay. Fundraising is about building relationships. There are obviously other parts of that, but that is a very important component to it. And I love that you led with that. Let's go with Yassine.
Yeah, Yassine.
Yassine, where are you calling in from?
New York City.
Love it. Tell me what you think fundraising is.
I think fundraising is storytelling and being able to communicate ideas of tomorrow.
Okay. Tell me a little bit more about why fundraising is storytelling. Connect it to more of what you have to do.
Yep. And so I think when I think of what I'm doing, it's very objective, makes perfect sense. But when I'm selling what I'm doing, it's very subjective. And so the people make decisions based on not rationality, but irrational and based on emotions. And so how do you trickle those emotions? Through storytelling.
Awesome. very, very advanced grasp of fundraising. So, but I did hear this idea of like selling with stories. Andrew, maybe the last one, Andrew Mao, do you mind sharing what you think fundraising is?
Yeah, so Andrew, I'm from New York City. Been out in the market a bit, raised a bunch from angels, and kind of took a crack at the VC market last fall. Even got a term sheet, but it was a really predatory one. And so I'm still kind of understand, like my process keeps revising over time because I'm doing it for months. But I think I agree with the relationships and storytelling. Those are all super important. I think what I'm seeing now is like convince, like those things in service of convincing someone that you are worth taking a bet on,
Mm.
you know, at the early stage. Like, and it's right. It's not whether it's like the numbers or the story or the FOMO or whatever, like making people feel like you're a worthy bet.
A worthy bet. Okay. Convincing people you're a worthy bet. Let me do one more. Gina, do you mind sharing what you think your perspective on fundraising is?
Sure. I think it's more of like a sales process where it's about fit, you know, and it's really like where you're offering an opportunity and the other side is like, is it a good fit
Awesome.
for what they're looking for?
So sales process that you're just trying to match the opportunity with the buyer. Okay. None of these are wrong. None of these are wrong at all. In fact, they all have a place in a definition of fundraising. I think it's really important to draw a distinction here, though. Here's the image that I like to make sure people think about when it comes to fundraising. And I believe that even the people that volunteered today, which by the way, I feel like founders are even more evolved than they were last year and the year before, because the answers that you gave are actually a way deeper understanding of fundraising. But when I think about even this idea of so directly connecting sales to fundraising, even selling with storytelling, it tends to paint a picture that is much more of the diagram on the left side of can we find the people that have money, and can we have this amazing product story and just sell them and run a process where we're selling them. We're trying to connect an opportunity with a buyer, which is not wrong, right? Like we'll talk a lot about in my processes about target lists and the similarities between sales and fundraising. They're close cousins. They're not exactly the same, but they're cousins. But there is a distinction that I think is really important that all founders try to embrace, which is try to get away from this mentality of the left side, which is around chasing down money. Can we find them and sell them? Can we almost like trap them and give them our opportunity? Sometimes it feels like we're tricking them. And what I would say first is that fundraising should really only happen successfully if you deserve to be funded, and that if it's a right fit for you. I do think that if you follow content out there, I think Elizabeth Yin does a great job of sharing content. My stuff is not so bad. I'm a little biased, but I think it's good. I think if you guys were to really go deep into stuff like investor psychology and understand the dynamics of everything, founders who, one, don't deserve to be funded and maybe don't actually realize they don't really want to be funded will get funded. They'll follow the stuff to a T and they will get funded. And I want you to know that that is a really bad outcome. When I work with founders, if through the course of working with them, they find out like, I probably shouldn't be raising, that's actually a good outcome, because if you successfully trick an investor to invest in you and the stars aren't aligned, you're in for a world of hurt. Now, if we can get past that and believe that, yes, we actually know why we're raising capital and we deserve, as one of the people that volunteer, we deserve a good opportunity to accept capital, then what is really important is that we reorient everything that you do, both the way you think about yourself and your company, as well as the processes that you run, to be something more like the right side of being chased. So instead of chasing dollars, we're trying to set everything up such that you're this incredibly shiny opportunity, great unicorn, a future unicorn with a very special founder so that it attracts investors to look at the opportunity like they are excited to have this opportunity to even invest in you and not the other way around. Okay, so that's what we're going to be focused on a little bit today. And the core of that is, there are a few things that we'll talk about over the course of these 3 days, but how do you get to a point where you're chased? How do you be chased? And the first thing is knowing. It's knowing that you are actually a good fit for VCs. And I know that sounds kind of vague. It's like, yeah, I know, like I want money, they should invest in me. But if I were to go down this list of, 200, 300 people who joined us today, if I went to Adelaide and said, Adelaide, why are you a great fit for VC? I'm not going to ask you that right away. If I went down to everyone and I talked to Tim and I talked to Bree, I talked to Jerry, I would venture to guess, based on the data that I've seen, that 80% of you would have a really, really weak answer, in my opinion. As an ex-VC, as an ex-investor, as an angel investor, as a coach in this, I would be disappointed in the answers that you would give. And if you don't understand why you actually are a VC-backable business, then how are you going to convince people to invest in you, right? So this is why this question is so important. I think about this idea of like, how do you know? And that's what we're going to jump into because, we'll talk about where people really mess this up. But how do you know? So I want you all to think of the answer to these two questions. It's because I'll be talking to a bunch of you, actually go through a live exercise. But in your head, think about what you do, what stage of business you're in, as in what you're generating right now, and also what round of funding you're going to go after. Are you going after angels? Are you going after a pre-seed round, seed, Series A, Series B? And then what your business model is. How do you make money? Or how will you make money? I assume most of you feel like you want to make money in the future. We're no longer in the market, which we'll talk about, where you can raise tens of millions of dollars and not make money. So think about these questions and we'll come back to them. The thing that we're trying to answer is, are you a VC-backable business? Are you a VC-backable business? So I think we need to talk about, what does this mean? Adelaide, I gave you a second to gather your thoughts, told you I wasn't going to ask you right away. When I said, I'm not going to ask you, you're like, oh, thank God, I don't have to talk to anyone. I'd actually like to ask you, do you know, or what do you think it means to be a VC-backable business?
I know it's definitely later in a stage than where my company is. But yeah, I think that being a VC-backable business means that you are not debt fundraising. You're not fundraising because you need the money. You're fundraising because you need to scale. You need to get yourself to that next level of success. So you have a company that has traction. You have a company that's at least revenue positive, if not on the verge of profitability. You're like ready to move into becoming like the dominator in your space. And you just need that like investment to kind of get you over the hump and get you that network of like users and such.
Awesome. Well, Adelaide, you went on the other end of the extreme of what I usually see happen. And that she was like, this is not for me. This is not for me. Like, you got to be so much further along. It's actually not true. Not true at all. Venture capitalists will routinely throw money at people that have nothing. In fact, like there's a whole strategy to find founders who have not left their jobs and try to give them money to go leave their jobs. So actually,
people's names.
I know, right? That costs $19.99 and it's on my website. No, so I actually appreciate how like self-facing and humble you are about like, oh, it's not for me. You're actually on the other end of the spectrum. And we won't get into it now, but I just point out how wrong Adelaide is. Like, she has this misconception of what VCs are, and the fact like she couldn't go after VCs right now. let's ask other, and by the way, I'm not like shitting on you, Adelaide. I'm just like, let's try to get to a better understanding here. So let's go with Guy. Guy. By the way, Adelaide, where were you calling in from?
So I'm based out of Philly, but I'm currently in Tampa.
Love it, East Coast. All right, Guy.
Yeah, nice to meet you.
Nice to meet you. Where are you calling in from?
I'm from Montreal, Canada, but I live in Latin America half of the year. Yeah.
Interesting. I think I'm talking to the wrong Guy. You don't have your hand. Sorry.
Oh.
Jeremy Sakajiri.
Hi. Hi, Jason.
Hey, how are you? Where are you calling in from?
I'm calling from São Paulo.
Muito bom, cara. All right.
You can call me Saka.
Saka, can you tell us what you think a VC-backable business is?
Yeah, I think the most important characteristic is it needs to be fund returner, like maybe return like 100x the investment amount. And to do that, like also needs to play in a huge market where it's possible to create a fund returner. So if
okay, let me double click on this because Saka has said some of the right words, but I want to like underline something to show you guys how much more you guys need to understand. Why is it 100x, Saka?
It's kind of the power law, like one VCs normally invest, like a few of the companies make the most of the return of the fund. So I don't know exactly the numbers, but if you're investing in one company that returns like 100x, even if the other ones like returns very little, it still gives the profitability that the fund needs to give back to their LPs.
Yeah, that's right. So broad strokes, you're accurate. Why is it not 50x or 10x or 200x? Is it always 100x?
Maybe it's just how, I don't know the math, but it's probably like
I'm being a little bit annoying. And don't worry, like 99% of the people that I ran through this would have a very similar answer. Okay, so you were very good, by the way. Power laws, rule venture capital, fund returners are what people are going after. But when you think about your business and how you're going to be pitching VCs, you got to sharpen your pencil a little bit more to really understand what story you're telling and what type of company you're running. Okay, so Guy had some good answers there. Let me go with one more. Mike, I think you had your hand raised. Is there anything that Saka or Adelaide missed that you want to add?
No, I was just gonna. I have the same answer as Saka, that you got to be able to return the fund. My answer to why it's 100x would be average portfolio has 30 names, and you need to have a 3x fund if you're a VC, and so that means 300xers.
Cool. We're getting closer to the answer. Mike, where are you calling in from?
Chicago.
Chicago. Very cool. All right. So let me we won't go super deep into this. We won't go into the math. I'm going to repeat essentially what Saka and Mike said a little bit. But what does it mean to be a VC-backable business? Well, it really means that you fit into the VC business model, right? Like that they have a way of doing business, which is we invest in a type of company that has a certain profile that can return a certain amount of money, and we have a consistent strategy. And when we have that consistent strategy, we are able to model out what we think is going to happen when we invest. And what does that company need to do? Well, it has to have massive potential. And I deliberately use the word massive as a fairly ambiguous term because of exactly the questions I was asking Saka, which is like, why does it have to be 100x? Why is it not 1000x? Why is it not 50x? Why is it not 10x? Massive potential means that they are able to generate the multiple that allows their portfolio construction theory to work. So it's really based on risk and where you are in the company. If I go and find the names of people and I'm like, oh my gosh, let's see, Irina, she's working at DoorDash. She's an up and coming engineer. I'm going to give her money to leave that company to start another company. The risk there is super high. She wasn't even thinking of starting a company. I just think she's really talented. Now, the loss ratio on that is going to be really freaking high. Like if I go to Kieran and try to get him to go, he's going to fail. He's definitely going to fail. I'm just kidding. I'm sure you'd be successful, but like, 99% of these are going to fail. And so you need to believe that I'm investing in something that when I put my money in, that's going to be 100,000x maybe in terms of where those ratios are in. But if I talk to Nathan, Nathan's doing $1 million a year. Well, he's already got kind of a business. Maybe he's not scaling it yet, but like he's making some money. I don't need to underwrite that to be 1,000x, right? It just has to have massive potential relative to where I'm investing. So once you understand that's like one of the biggest things, then you can go along to the second point, which is like, okay, if in the numbers and we're trying to say like, oh yeah, they're running a business that is in this field and has this size potential. Now I'm analyzing, is Matt a great founder? Can Ali actually like attract the right team to bring this to the promised land? They have it in their heads that they actually want to build a gigantic business. Like that's a really big part of it too. You might be building a fintech company, SaaS company, but like if in your head you want to run a lifestyle business, which I love lifestyle businesses. If in your head you're actually kind of like running lifestyle businesses, that's going to be one of the more important things that comes out. At the end of the day, this is one of the biggest problems I see in the market. A lot of times I'll start workshops and I'll say, look, 80% of the people in this room really shouldn't be trying to raise venture capital dollars. It's obviously like a finger in the air and a bit of a jarring comment, and it's made to do that for these reasons, is that I want people to think like, whoa, why am I not in that 80%? Why I'm in that 20%? Or why might I be in that 80%? So people deeply understand, what does it mean to be venture backable and what should I be going after? I think people think I'm running a business, a good business, maybe even a great business. I'm running a great business. I need money. I'm going to go after venture capitalists. Just because VCs are the name of the type of capital source out there that most people know about. And that is one of the biggest mistakes that you can make. It affects everything from one, you shouldn't be going out after VC if you don't fit. And then two, if really you should be, you're building a great business, a massive business, and you're a great founder, but you still don't understand those dynamics, you're not going to be able to understand what you're supposed to be communicating to these VCs. Okay. So we're going to go on to the exercise portion of this workshop. Remember those questions that I asked you, because we're going to do some math. You guys like math? Lucy? No? All right. What I'd like, Adriana, I saw you nod your head. That might be a volunteer. What I'd like for you guys to do is throw into the chat a one-line description of what your product is, what your product or service is. Don't sell me on it. Just tell me what it does or what it is. I'm gonna pick some of you to engage based off of that. At the chat right now. Okay, let's go around the horn and have you guys share one sentence on what you do. You're not selling us, you're just saying what you do, okay? And then what your business model is. Let's start with Faith. Faith, what do you do and what's your business model?
We stream independent film that are hard to find with a 50-50 revenue model between us and the filmmaker. And we have watch parties, so anyone in the world can watch with friends or make new friends. Hard to find independent movies that are only available in film festivals.
Okay. Independent film festivals, streaming party with 50% revenue share. Great. Sakiko, what do you do and what's your business model?
We use cell taste receptor research to create objectively delicious, sweet tasting ingredients and products. And we also do tissue research to make sure that these creations are actually health enhancing. And we sell these products directly to the consumer under the brand name Nomosu, which stands for no more sugar. And we're also starting to help other food companies to create healthy, sweet products as well.
Okay, a D2C candy store. Sorry, I know that might make you cringe. But I'm just trying to make
Healthy candy, I would say.
yeah, healthy candy. And I'm purposely being extreme when I describe these things. Lauren, can you share what you do and what your business model is?
We are a rental clothing membership for babies and toddlers so that parents can exchange their clothes as their kids grow. We have two revenue models. One is direct to consumer recurring revenue membership. And then the second is a B2B model where we work with retailers to resale their clothing and add it into the inventory.
How far along are you?
We are revenue generating and made 80K this year.
Okay. So you've
Last year.
models.
We are primarily D2C and we're dipping our toe now in B2B.
Okay. I would definitely encourage you to focus, but that's neither here nor there. We're going to focus on your D2C model as subscription rentals. And last but not least, Alex, what do you do and what's your business model?
So what do? We use real-time insights into employee calendars and sentiment to give both employees and management a real-time view of how their time is being spent towards achieving company goals. The business model is B2B SaaS, so monthly subscription.
How much does it cost? Roughly.
$7 a month. $7 per month per person right now.
Okay. So SMB is focused, right? Like very small customers.
Well, for now, yeah, SMB for now, and then we will be building it out for the enterprise. That's obviously where the whales will be.
And sorry, just quickly, what stage are you in? You're at?
Launched in June with 3 pilot customers. One has converted to a paid customer.
Great. Faith, where are you? What stage are you?
We launched a no-code version of our site where we stream movies for free last a year and a half ago, and I haven't launched the new site yet. I've been working on it for about a year. I'm programming it myself, so it's been quite an endeavor.
Awesome. And Sakiko, how would you describe your stage?
I would describe it as post-revenue, but Series A kind of stage, fundraising stage.
Okay. I'll just go by your word around Series A. Okay, so let's do this. We're going to have a little bit of a math exercise to talk through this. We've got Sakiko. Oh man. Sakiko. We've got Mike. We've got Faith and Lauren. Except for Sakiko, they're all fairly early stage. Here is the exercise that they need to be going through, that you all need to be going through as you think through these things. For the really early stage companies, I'm going to throw out a number, a valuation that we think we can get to that is going to be really healthy given today's market. But we're going to use it as a instructional starting point and say $10 million is what we can get Faith, Mike, and Lauren to be able to do. Sakiko, I'm not going to actually, what do you think? What would be a valuation expectation for you for Series A? And you can say, I have no freaking clue. It's kind of why I'm in this workshop. But I'm going to push you to be like, I know you've talked to people. So give me a number that you think would be great to be able to land in a Series A valuation.
40 million.
40 million. Great. Okay. So these are valuations for Sakiko's the 40. Mike, Faith, and Lauren are at 10. Now, this is where what we talked about comes into play. Return expectations. So when we think about an earlier stage company, we are saying, okay, super high risk. Faith has a no code version of her product out. Mike has tested something out, converted to one customer. And Lauren has maybe done more, but 80K of revenue. We still think there's huge opportunities for these companies to go to zero. We want to say our return underwriting expectation has to be 100x for them. Okay. That means I need to believe that Faith can build a business that is going to return 100x on my investment. With Sakiko, I'm going to say a little bit easier and say, because we're at Series A, she's in market, she's a product, we'll say 20x. 20x. Now, these are not specifically scientific numbers, but they are ballpark. They're going to be ballpark given where I think Sakiko is and where I think these people are. Next, we're going to do revenue multiples. What do we think the revenue multiples of these companies are? With Sakiko's doing, let's see, D2C retail. That range is like 2 to 5x. And I'll be nice and I'll say 5x. For everyone else, I'm going to give you all SaaS multiples, even if you don't deserve them. I think SaaS multiples in the market right now are something, the public markets are less than 10x. Let's just say 10x. Again, I'm doing this as an exercise and I want you all to be doing this yourselves. You should be thinking through these things for your company, because what we're getting to here is a little bit of math. So if at a $10 million valuation, I expect a return of 100x, what does that mean the company needs to be valued at exit in my model? You can shout it out. You can throw it into the chat, actually. What is that number?
1 billion.
1 billion, exactly. $1 billion. And for $40 million valuation, and I still need to see possibility of 20x, what is that? Yeah.
800 million.
Thank you for answering. $800 million. Okay, so these are the valuations of companies that we need to be able to squint our eyes and be like, Sakiko, I think, can build an $800 million company. I think Lauren can build a $1 billion company. And this is where a little bit of the math comes in if you haven't been in finance, if you haven't done these things. What we're actually trying to get to is, what does that company need to look like at that stage in order to be valued at $1 billion or at $800 million? And this, again, is not super accurate, but what we're doing here is saying, okay, let's take the revenue multiples in the public markets, divide that by those numbers and say, okay, the SaaS multiple of 10x at $1 billion, what does that mean? Anyone want to throw it into the chat or yell it out? That would be $1 billion divide, exactly, Tim, Rodrigo, Usman. $1 billion divided by the 10x multiple means you got to be doing $100 million of revenue a year. Let's do it for Sakiko at $800 million divided by 5 is 160 million. Yeah, $160 million of revenue. Okay. So now this is where the business model comes in. Can we get all these people on stage again? We've got Sakiko, Mike, Faith, Lauren. What we're going to be talking through here is, what do investors need to believe? What do investors need to, oh, sorry, Alex, I keep saying Mike. Thank you, Gogan. What do investors need to believe in order to say you're doing 100 million of revenue a year? So Alex, are you there?
Absolutely.
Alex, and obviously oversimplification here, but $100 million at $7, is it $7 a month or $7 a year?
$7 per person per month, yeah.
Per month. So let's just make it easy and say $100 per year. How many customers are you going to need to convince VCs that you're going to land in order to be the valuation that they need you to get to in the end?
10,000 around there.
10,000, 100,000, million, 10 million. I think it's 100,000, right?
Okay, 100,000.
No. You need to be at 100 million. You need
1
1,000.
million.
Yeah, you need it's easy math. You need 1 million customers. 1 million customers at $100 a year to do $100 million a year to be $1 billion valuation. Sakiko needs to sell $160 million of revenue. How much does one of your chocolate bars cost retail?
Retails in the US right now at $6.99.
So let's call it 10. Let's call that $10. That's 10 million chocolate bars a year. 16 million chocolate bars a year. Faith, how much revenue share? So how much does a film go for?
So it's $4 for a short film, $6 with our current model. Again, we haven't launched, so it's subject to change with a 50-50 revenue share. So I think we need 500,000 subscribers.
Okay.
But it depends on how much they watch as well. So
yeah. That one is going to be hard for me to do in my head right now. I'm usually really good at math. Didn't get a lot of sleep, but okay. So even if, let's say you're accurate there, 500,000 streams, I think it's way more than that. But even at that, and the last one, Lauren, what is your subscription cost?
Yeah, it's about $40 a month. I think we need about 230,000 monthly subscribers.
Okay. So thank you guys for going through this exercise. This is the first time I did it with so many people popping up, and round of applause for everyone to share all this stuff with me. This is not easy to do, and to be put on the spot like this is tough. Now, here's what I'm going to say. I believe all these stories are venture backable. Okay. Actually walking people through all these things is not meant to be like, look at all these people. Alex thinks he can get, 1 million people to buy his product. How, right? Or Sakiko, she needs to sell 16 million chocolate bars. How's she going to do that? How many does Hershey actually sell? That's actually not meant to be the exercise here. What I want is, and we can unpin everyone now, Jonathan, I want everyone to think about, how do they fit into the VC model? Like, how do these people fit into the VC model with these numbers that are actually fairly to squint and to think about things? How do they tell these stories? And Alex, I totally understood what your business probably would be. And again, oversimplification, but let's take, for example, Sakiko. Sakiko with a no sugar chocolate bar or candy. If we just said she needs to sell 16 million chocolate bars, that needs to be a fairly popular chocolate, I think, in order to be fairly mainstream. But I think there are parts of the story that we don't know about. Like, where does this brand go? What else could it do? What other products could she get into? Like, if she really squints her eyes, if she really talks about her dream, what is Nomosu like? Is it the next Hershey? Is there a state of the world where the world really wakes up to how poisonous sugar is, not just for people that have a specific illness around it, but for everyone? And the world moves into a specific place where there's more regulation, there's other things. Like, what does the world look like that she believes exists, where it's not about, when you think about 16 million chocolate bars, it's no, it's 100 million different types of products that all have this one thing, right? And so when I think about her product, it can be very easy to be like, well, this is what I do right now. And then you're like, okay, 16 million chocolate bars that are no sugar chocolate bars. But what's really important for anyone is to say, well, what is the state of the world that I believe in, that we're working towards? And then what you're doing is you're fitting to that, right? So when I think about Alex, $7 per seat, I think is really what it was. $7 per seat per month. It's a small, I mean, it would require a lot of customers in order to get to the number that he needs to, even if you were able to onboard hundreds or thousands of customers per enterprise customer. But he can't be trapped in this box of thinking, what am I doing here? Getting to 1 million of these seats. He needs to talk about the pain point and the direction and where this expands. $7 per customer today, but that's just the starting point to create a customer relationship, to understand other things. This is hundreds or thousands of dollars per customer easily by the time we get to the vision that we're trying to play out, right? Faith also, there's an opportunity to really talk about where the media industry goes and why creating this relationship with customers becomes a very, very big thing. But she needs to understand the world that exists in the future that makes her company actually fall into these models, right? And then Lauren, look, I think there's a lot of consumer subscriptions out here, but you talk about adding to the cart, and maybe it is a B2B model. But in all these exercises, there are two things that I am trying to do. Is if when I talk to you about doing this math and it scares you, you're like, I didn't really want to do that. I have a customer that I'm trying to solve a problem for, and I know I can do that. I'm not actually trying to fit into a $1 billion business model. Then that's okay. In fact, that's awesome. You shouldn't be going after VC. But if in your heart of hearts, you think you're building a big business and you want to go after it, then you need to be thinking about, how do I tell this story in a way that is gigantic, that fits the VC business model, that then makes them think, okay, Adelaide is a killer and she wants to build this big business. I want to back her. Sakiko, that's an interesting vision of the world. I believe that something like that is going to happen. I think sugar is a poison, and a lot of people are going to wake up to this. So these are all things that I want you guys to think about. That's really important. Just so you know, we did expand this session for another 15 minutes. I hope you guys can stick around so I can tell you about what we're getting to next. So I feel like we've solved that initial problem of what does it mean to go fundraising? What does it mean to be venture backable? So now you understand what it takes. But now that we know what it takes, you should realize that things have changed. I think if you've been in this space, startups, fundraising for the last year, you understand that the sands are moving in underneath our feet as we speak. Right? A year ago, this is a real story of a fundraise that I helped with. Thursday, they were like, we're going to start fundraising. Friday, they presented for the first time. Sunday, they had calls. By Monday, they had a term sheet for $5 million. That was a real life story that happened last year with crazy valuations. And it wasn't the only one. It happened a ton. But that's not the market that we're in today. This is completely changed. This is a meme that I saw, and it's a meme and it's supposed to be a joke, but it's completely accurate. The diligence that I was seeing people do was laughable in 2021 and early 2022. Today, they are taking their time. Processes are moving slower, and essentially the bar is getting way higher. What you need to be able to do, what you need to be able to convince people that you are a VC-backable business is way more. And so that's what we're going to be saving our time for on Wednesday's session. Today, we were able to answer, are you in the right place? Are you doing the right thing? Do you know what it means to go fundraising? And hopefully we were able to answer that. Wednesday is okay, the bar is higher. Can we convince them? Can we actually convince people? So I hope you guys join for Wednesday. We're going to be talking about narrative skills, narrative exercises. The live exercises will be around that. If we can get part 2 out of the way, I'll feel like I've gotten you guys on a really, really good path to being better about fundraising. So that's our session. I'm going to leave 5 minutes of Q&A in case anyone has burning questions based on today's content. Let's try not to veer off to crazy other things. But if you could go ahead with the digital hand raises, And by the way, this is the hour. The last 15 minutes is meant to expand so that you guys can ask questions. But I do hope that I see you guys in Wednesday session. By the way, if no questions, I'm super happy to give you guys your time back as well. Oh, can I please go through the math again? That's a good, happy to do that actually. I think people want to see this math again. Okay. What is the valuation that you guys think you're going to get to? Let me run through this again. On that. 72. Okay. Valuation. Let's say you're going in, we'll do different numbers. Oh, I did actually want to say, what's the other thing that people can do in order to fit into a return multiple? I'm glad actually someone asked this question. So the other part of the math that someone can change in order to fit into 100x, a 200x multiple, is actually to raise at a lower valuation. Now, think about it, right? Like if you're looking at your company, you're like, wow, I don't think I can get to $1 billion, nor did I want to build a $1 billion company. How do I become a 100x multiple? How do I become a 50x multiple? Well, another way to do it is to say, I think I could build a $250 million business. I've seen companies exit like that. And that sounds like a business that I want to run. I don't have to go public to do that. Well, if you raise your first tranche of capital, maybe $250,000 at a $2.5 million valuation, that actually fits a business model. And I want to make sure that people understand like what that means. $2.5 million for a company in comparison to what you've heard in the market might be like, what the hell? I heard some people were raising at a $10 million valuation, but those are all made up numbers anyways. Like it's like we're putting a valuation. It's just what the market is willing to pay. And we're putting a random valuation on your company that could be like a slideshow. But if you're able to get the $500,000 you need, the $250,000 you need to actually build your first product and then start selling, and you only sell 10% of your company at a $2.5 million valuation, and that gets you on the path to actually building a $250 million company, that's an incredible outcome. So the other part of the math that I didn't share with you is there's a numerator and there's a denominator. You could also change the valuation number. You don't have to change how big, you can change the denominator essentially. Okay. Let's see. We still need to go through that math. Why don't we do it? $2.5 million valuation, 100x multiple, because that's what pre-seed seed investors are looking for. That means $250 million outcome at a 10x multiple means now we only need to be doing $25 million of revenue a year in order to actually fit that. Alex, let's say we're doing $100 a year. Now we're looking at 250,000 customers, which is still a big number, but like kind of doable, you know? Like there are different ways to think about venture capital business models. Okay. Let's go to someone new. Keisha, how are you?
Hey, how are you, Jason?
Good. Where in the world are you?
I'm in New Orleans, but I live in San Francisco and New York, but I'm out here talking to creators, so I had to tap in.
Awesome. What's your question?
My question is in regards to the 100 million. So what is an exciting time horizon for when that should occur? Should it be 3 years? Should it be 5 years? Because we can say we're hitting 100 million, but if it takes 12,000 years, then that doesn't matter. So yeah.
I actually think exit horizons are quite long. So there are two timelines I think you should be thinking about. One is in the future of like modeling out, can you get to this in year 7 or 8? I think is reasonable. But the other thing that you should be thinking, so that's like the end state. I think the other thing that people mess up is knowing what they need to get to the next round of capital. So like if you can talk about those two things, you'll have a much better time convincing VCs. It's like, yes, we can be $1 billion company. Also, we know what it takes after we get your money. We know what it's going to take to get to the next crunch of capital. Here are the milestones that we need to get to. This is what we're going to get done.
Thank you.
You're welcome. Let's see. Who haven't I? Stuart.
Hey, Jason, how you doing?
Hey, where in the world are you?
I'm currently in Panama City. I'm a full-time digital nomad.
Love it. I used to be in that boat as well. What's your question, Stuart?
Question for you. So Lios is a travel app. We're currently pre-launch. We're at the MVP stage and we're beta testing with our target audience. I've been given some advice that it's better to raise early funding prior to launch rather than post-launch. Do you have any firm thoughts on that? We're kind of on the cusp of having a product that we could launch fully available. At the moment, everything is internal testing within the different stores. Do you have a strong opinion on whether there's any kind of tactical play there, or we should just develop at the pace that we feel is right for the business?
So I know exactly what that piece of advice is about. In general, I would say you got to do what's right for the business. But the advice that people are talking about is commonly described as you can either raise on the dream or raise on data, and you can only raise on the dream once. So when you raise on the dream, you get to tell a story of what's going to happen. You're like, we're about to launch this thing. When it launches, it is going to be insane. It's going to go like this. It's going to be amazing. The moment you launch, though, they're going to be like, you said it was going to be insane. Let me see the numbers. Let me see the numbers. What do the numbers say? The numbers say it's going to be insane. And so it's hard for me to tell you what to do because I don't know what your story is. I don't know what you believe is going to happen. But my guess, honestly, is that this is more going to be determined on how prepared you are to fundraise. And if I had to guess, you're less prepared than you should be, in which case you should just keep running your business and prepare to fundraise and then do it after you launch. But if you've already prepared and you have a list of people that are chomping at the bit to invest and you need to just run the process, raise on the dream, and then get back to work. I think last thing I'll say about that, all things being equal, let's say you have a fully prepped list, you know how you're going to fundraise, and you're like, okay, I could raise now, and let's say I could, and I'm just using round numbers. It's nothing to do with who you are. I could raise at a $10 million valuation now. But if we launch, like, it's going to do all these different things and explode, I could raise at a 15 or even a 20. In some, like, if you could actually do both, I would raise on the dream because you don't know what's going to happen. It could completely fall on its face. And then people would say, like, the dream that you described no longer exists. But these are hypotheticals because what I said is, could you go raise on the dream versus what, and raising on the dream is, like Alina accurately mentions, is like, it's harder to do nowadays, right? People are scared. They used to be YOLOing into deals last year and they're not doing that anymore. Okay.
Thank you. That's helpful.
You're welcome. Let's see. I'll try to go back and forth here. Philippe, are you there?
Yep. Thanks. I'm coming in from around Toronto in Canada.
Love it. What's your question?
Question I have is, say that again, sorry?
No, what's your question?
Sweet. What are reasonable post-money valuations that we're seeing in the market right now for companies raising at about a pre-seed? And then a follow-on is, are standard YC safes a reasonable expectation for most pre-seed investors? Or
you mean is the format or the valuation? So there's two questions?
Yeah, two questions.
You're only allowed one, so I'm just
fair
kidding.
enough. We could start with the first one then, which is reasonable post-money valuation for a pre-seed.
I'm kidding. I will send you I'll send everyone a couple links around recent valuations that have come out from a few of our partners. Carta and AngelList have published some of those things. What I'll say is the numbers that got sent out are showing a steep decline. They're still lagging numbers. So my belief is the numbers that I'm going to send you are like 6 months behind. I think pre-seed valuations right now are going to come in between like 4 and 8. And I think seed valuations are going to come in between 8 and 15, A's between 15 and 30, and then so on and so forth. super thin market though. So there's like not a lot of data. Things are just happening as VCs are pushing it. And then, yeah, YC safes are still fairly standard to raise early stage capital on.
Great, sweet, thanks.
You're welcome. Angelina?
Hi, thank you for the session. I had a couple of questions.
Yep.
I was wondering is that other investors like family office groups, corporate groups, do they have the same model as the VCs, or is their model completely different? And should I ask all my questions now?
Yeah, ask your questions, and if
Okay.
they're too far apart, then I might jump to somebody else after the first question.
Yeah. So that's the one question. The second one is, let's say you feel like, yes, I have the vision, I can get to that 100x return. Is the VC investment source the best one for that? Or should we be looking at other, let's say, corporate investors? Or there are other areas that we should be comparing and saying, is the VC the right route to take? And thirdly is, if we're impact based, how much does that play in the role of VCs and the valuation that you shared with us? And if we are impact based, is it just basically don't even bother down the VC route because they're just so numbers focused that it's not if you can't throw the numbers in, they don't really care.
Yeah. Okay. So I think there's actually a worthwhile first answer to give, which is asking what specific investors you're talking to, like what their model is, what they need to underwrite to, is a completely fair question to ask, especially if, like you said, your impact and like you need to understand how they make decisions. To your first question, I'll take family offices first. Family offices in general will still run a portfolio theory in terms of like what hurdle rate they're trying to what they're trying to underwrite to, and they're all trying to make money the same way, right? So different family offices have different strategies. Sometimes they blend investments because they can just, it's like, we're billionaires, we're going to invest in anything. Other times they'll try to model their capital deployment strategy after traditional investing, so venture capital, private equity, hedge fund, public markets. So in that case, if they are following it, they will follow essentially the same sort of return portfolio theory. When it comes to corporates are a little bit different. And corporates can be like, different corporates have different priorities. Some are like, we invest to break even / lose money, but we're here to learn. Or we need to further a certain technology. Sometimes the corporate VC is spun out and they have the same ROI objectives that other VCs have. So I can't say directly for every corporate. And then when it comes to impact, look, at the end of the day, I think VCs are still businesses, whether or not they say they're impact investors. So like, they might be impact investors and they want to only support deals that have impact, but they're also going to have to like underwrite the business model the same way. To me, if you're not like a focused impact investor and you say you enjoy or you like impact, it's just a way to look at some deals, but at the end of the day, they're going to have the same like evaluation of, can you return the fund? Okay.
Thank you.
All right.
That makes sense.
Guys, that's the end of the time together. Even with an additional 75 minutes, I think we could have kept going. But next session is really important. I hope you guys don't miss it. It's all about narrative and the tools that you're going to need to really meet this higher bar. Before last year, a lot of what I would teach was all momentum based. It was like, can we generate this momentum to go crazy? Now it's like, hey, can we get the fundamentals in place so that a VC feels comfortable with what they're doing? So that's what next time is all about. I hope you guys enjoyed this session. And like I said, follow me. I would love for you to listen to my podcast. And if you do listen to my podcast, leave a review. That really helps. And share with people on social that this was great, because I'd love to see more people in day 2. Thanks so much, everyone.
Thank you.
Thank you.
Thanks.
Bye.
Take care, guys.
Thank you.
Thank you.
Thanks, Jason.
Big meat bologna cheese
Jason,
sandwich.
take care, guys.
Thanks, man. Yeah, put a lot of mayonnaise on my shit. Who this?
Thanks, Jason.